Welcome to Taking Stock. I'm Amanda Lang. Coming up on the show, despite Canada's relative wealth, why are so many of its citizens going hungry? And mortgages are rolling over this year and next. How will homeowners fare? Plus, the Minister of Jobs and Families on preparing for the future. That's all ahead. First, for the week that was in business, it's time for the briefs. The IMF warned against complacency this week, suggesting that global economies are too comfortable with risks, including trade wars and geopolitical tension. That raises the specter of a sharp correction if anything upsets that outlook. It also noted that many assets are highly valued, priming them for a fall. Markets certainly reacted to China's export restrictions on rare earth minerals, the vast majority of which are mined and processed in China. The new rules take effect on November 8th and December 1st and escalate the trade war between the U.S. and China. It also opens a new front in that war as supply chains globally, which rely on those rare earth metals, could become snarled. That could hit everything from computers to cars. Manufacturing sales in Canada contracted 1% in August, according to StatsCan. That followed production declines in autos and aerospace. Sales fell in 12 of 21 sectors. Aerospace products and parts fell 8.6% in the month, with motor vehicle parts down 5.2%. And in a fresh blow to the auto sector, Stellantis said this week it will move production of the Jeep Compass from Ontario to Illinois. It's part of a pledge by the automaker to invest $13 billion in the U.S. over the next 4 years. Retooling at the Ontario plant was halted last February in the face of looming tariffs. OpenAI has made a deal with chipmaker Broadcom to develop its own AI chips, with OpenAI doing the creative work and Broadcom developing and manufacturing the processors. Financial terms of the deal were not disclosed. Broadcom's stock popped nearly 10% on the news. U.S. fuel distributor Sunoco got the green light from Canadian authorities for its takeover of Calgary's Parkland, a fuel retailer and refiner. The $9.1 billion U.S. deal was announced last May, but had to clear the net benefit test for approval. Parkland owns Ultramar, Chevron, and Pioneer gas stations. And those are your business briefs. With unemployment at multi-year highs in Canada, use of food banks remains also at multi-year highs. What will it take to make food more affordable? Neil Hetherington is the CEO of the Daily Bread Food Bank. Thanks for being with us.
It's great to be with you, Amanda.
We've seen these stats, Neil, and they're not getting better. We know that the volume of use is higher than it should be. I was also struck by a report recently, if I'm honest, that healthy food is even more expensive than less healthy, and I wondered how you cope with that. But let's start with just the sheer volume of customers you're facing.
Sure, it's been horrific. So now the Daily Bread Food Bank provides food for about 1 in 10 Torontonians. And so 330,000 client visits last month alone. And sort of by context, that was about 60,000 before the pandemic. So every year it has grown. On a positive note, we've seen the rate of growth decrease. So we've gone from the previous year of 38% growth. This year, in 2 weeks, we'll be announcing our growth rate of only 18%. It's still horrific, but at least it's down.
Those staying, it's a bit like inflation, isn't it, Neil? The growth stays with you. Those are people who are still using your services. Has your support risen to match it? Can you afford to stay at those levels?
The community has certainly rallied around the Daily Bread Food Bank, and so that's positive, but it's not sustainable. And certainly that's the Toronto context. Across the country, food banks are struggling. They're going to have to provide either less food or lower quality food. And so while I'm pleased to see the community rally, what I like to see even more is the community rally around some of the advocacy positions we have so that those lineups start to decrease, not only here in Toronto, but across the country.
Give me your top ones. What are some of the things that we should be pursuing by way of policy to help people who struggle with food security?
Well, the first one is affordable housing. And so I was delighted to see Anna Ballo take charge of the Canada Builds Home program, $13 billion invested in long-term capital that will result in homes being developed across the country. But we're not going to feel those effects for 5 to 7 years at least. So in the short term, we want to see rent supplements coming out so that people can afford to live where they work. The second is across the country, it doesn't matter which province you're part of, we treat people people on disability abysmally. Right now, if you're on disability in Ontario, you receive about $1,400 per month to survive on, and nobody can survive on that. So we lobbied hard with a coalition right across the country, and we're able to get the Canada Disability Benefit into force. It brings people's income up by another $200 per month. It's not enough, but it provides some hope.
And of course, there's also the worry about young people. There's lots of programs for food in schools. Is that meeting part of the need, or can we do better there too?
Well, we're one of the only countries that does not have a full student nutrition program providing a full hot meal at every school. When that is implemented across the country, the typical family will save about $800 a year in their food costs, and so that will take some of the sting out of the challenges that children face when they go to school hungry.
Neil, it's so good to have you. I wish we could stop having this conversation, but it's important to have it. Thanks for your time.
Thanks, Amanda.
Neil Hetherington is the CEO of the Daily Bread Food Bank. Coming up, mortgage resets and a soft labor market could spell pain for some Canadians. Stay with us. Welcome back. The majority of mortgages in Canada renew over the next 18 months. Here's a look by the numbers. 60% of all outstanding mortgages renew in either 2025 or 2026, according to the Bank of Canada. Of those mortgages renewing, 60% are expected to see a payment increase. Most of those will be 5-year fixed-rate mortgages. The average mortgage payment will be increased 10% for 2025 renewals and 6% for 2026 renewals, but they vary based on the type of mortgage, with 5-year fixed-rate contracts rising as much as 15 to 20%. Meanwhile, the number of mortgage holders who are behind on payments is rising ever so slightly to 0.23% of all mortgages that are 90 days or more late on payments. That's 11,430 mortgages out of a total pool of 4.9 million. Historically, missed mortgage payments track closely with employment, so weakness in the labor market, like unemployment at 7.1%, means higher likelihood of arrears. While the overall default rate may be low, there's little question that some mortgage holders are going to feel some pain. So what does that mean for the overall market? John Pasalis is president of Realosophy Realty. Thanks for being with us, John.
Thanks for having me.
So we do know that these resets are coming. People who have the mortgages obviously know they're coming. Do we have to worry about the broader market and the knock-on effect as people's mortgage payments get more expensive?
Yeah, absolutely. And we're starting to see some of the downsides of that now. I mean, arrears are up over the past couple of years quite significantly, and we're seeing an increasing number of power sales across the GTA. So certainly this is flowing through to the broader housing market as more and more households are struggling to keep up payments and either being forced to sell through a power sale or are just trying to get ahead of their power sale by listing their home on the market, trying to get out of the market as soon as possible.
I was looking at some of the data, and we can, obviously the national numbers kind of obscure those specific pockets of certain urban centers. In some places, prices have really come down. Now, they've come down, John, from a very, very high water mark. But for people that bought at those levels, and as we know, if people are resetting here, some of them did buy close to that high water mark. That's a big pain point. Is there a kind of a knock-on effect of that? Your mortgage is getting more expensive as the value of your home is declining. That can add up to a real problem.
Yeah, absolutely. And that's the challenge. I think right now it's not just payments, it's that house values are down. And this is one of the big challenges a lot of these households are facing. And you're right, prices are not just down from the peak. In the Toronto area, we're down probably low-rise homes about 27%. In some areas, it's even more. And some of these outskirts that have the highest ratio of power of sales relative to their new listings are seeing double-digit year-over-year decline. So that's from last year, we're seeing 10 to 15% price declines. So, of course, this is flowing through into softer housing prices right now.
It's interesting because, of course, there's a lot of policy that's supportive of housing prices because a lot of Canadians own homes and the equity matters. Should there be policies now that help in a situation like this? And I don't mean anything interventionist, but, helping people keep their home but maybe turn it into a rental or some kind of solution that cushions the blow for people who might actually find themselves underwater?
The challenge with that is there are two issues. I mean, certainly on the one side, it is the existing homeowner who, in most cases actually have equity in their home. This isn't like the US financial crisis where people buying zero down. Most of these owners have equity. They just can't keep up with their payments. And unfortunately, this is not like a short-term issue the way we saw in COVID. This has been going on for quite some time, and now it's starting to really weigh on households. The other side effect, the other issue is that demand is pretty much at 20-year lows. And this is, of course, what is weighing on the market. We have a very high volume of active listings. We have very low demand because a lot of buyers are anxious about buying in today's market. So I don't know if there are any great policy tools that can really address the dynamics we're seeing today.
I mean, you talk about some of the declines we've already seen. What's the worst case scenario in your view? How far could prices fall?
It's hard to say. I mean, I've been speaking with a lot of economists over the past week or so. And, the most pessimistic scenario is that, we're going to continue to see a double-digit decline over the next year. When the market recovers is anyone's guess. But I think the sentiment is that, next year is going to be a relatively soft year because we're going to continue to see a higher number of arrears, higher number of power sales. And again, part of this is buyer sentiment. When do buyers feel comfortable to jump back in the market? They're seeing prices decline, and until they see some stability, we're going to see really, really soft sales volumes.
And I guess we've only got like 10 seconds, but could you put a time frame on when you think a market like this bottoms out?
Potentially the second half of next year, if rates kind of stay low, if we're below 4%, buyers are feeling more confident. Again, it really depends on the economic conditions as well.
John, always good to have your expertise. Appreciate it.
Thanks for having me.
John Pasalis, president of Realosophy Realty. For mortgage holders with equity in their homes, there are some financial products aimed at helping free up capital. Shael Weinreb is CEO of the Home Equity Partner. Shael, thanks for being with us.
Thank you so much for having me. Appreciate it, Amanda. Thank you.
So we're talking about the stress that people feel, when their mortgage is reset, and there's obviously a lot of financial pain out there. In terms of the product that you have and who it's designed for, who do you consider the right customer for it?
Yeah, no, I think that's a great question. I think it's really anybody that's sort of experiencing financial stress, to be honest with you. So homeowners that really sort of, vary across the spectrum. It could be anybody, probably somebody in their sort of early 40s all the way up to their mid to late 70s. I think everybody, financial stress doesn't discriminate. And so, people, depending on where they are in life, experience different financial pressures. And I think, from an age perspective, it really caters to the entire spectrum.
And, just to kind of put it as simply as we can, basically your home equity takes a piece of the ownership of the house. You get paid out one day when the house is sold based on the appreciation. If it doesn't appreciate, you don't get paid out. Am I getting that right?
Yeah, I think it's really designed to be a program where we create alignment with the homeowners. And so if the house goes up in value, we both win. Conversely, if the house goes down in value, we both lose. So to the extent that the homeowner experiences wins, we sort of win alongside them. And if the house stays stagnant and doesn't appreciate or really depreciate and stays flat during the term of the relationship, then all we would expect back is our initial investment and nothing more.
And Shael, why would I do a deal with you instead of a straight up home equity loan?
So I think there's truly a couple of reasons for it. One is because not everybody is able to qualify for a traditional home equity loan. Yep. Banks, as we all know, are fairly conservative in this country and have strict lending criteria. Our underwriting criteria is a little bit more holistic and entrepreneurial than sort of some of the traditional lenders. And that's really what inspired this in the first place, is not only my father, but other people I knew were being rejected from some of the Schedule A, even Schedule B banks when trying to take out a home equity loan. So people always say, oh, why go with a HESA, which is our flagship product, a home equity sharing agreement? Why go with a HESA when you can just qualify for a traditional loan? It's not that simple. And so that's number one. And even if you do qualify for a traditional loan, the other burden that you would have moving forward is a carrying cost associated with the loan.
Right.
So, that could range anywhere between $600, $700, $800 a month. When you're really living sort of close to the edge and paycheck to paycheck in some cases, being able to come up with another $800 a month to service a monthly interest payment can be really difficult. And with our product, there are no monthly payments during the duration of the relationship. So it's easier, I think, to maintain than a traditional loan.
So good to have you for this, Shael. Appreciate your time.
Thank you. Thank you so much, Amanda. It was great to be here.
Shael Weinreb is the CEO of the Home Equity Partners. Coming up, cushioning the blow of a changing job market, the Minister of Jobs and Families is here. But first, the European Union has fined several big designer brands for imposing specific pricing on retailers. Antitrust regulators said Gucci, Chloe, and Loewe put restrictions on retailers, specifically prohibiting them from dropping prices beyond what the luxury brand specified and limiting the duration of sales period. The $180 million fine is intended to send a message about what we're not totally sure, since the real victim here are the shoppers of luxury goods. And all three stopped the policies when the investigation started back in 2023. We can't help but think this is a very good example of a champagne problem. We're back after this. Welcome back. Canada's labour force has a two-pronged challenge: support workers who are displaced right now and train those and others for the jobs of the future. Patty Hajdu is Minister of Jobs and Families. Thanks for being with us, Minister.
Great to be here.
I do want to start with, there's a sense that the labour market is experiencing weakness overall. People are feeling very insecure, especially about, of course, training for jobs for the future. What's your message today about kind of trying to extend confidence on those fronts?
Well, first of all, my message is I understand that fear and anxiety, and I've particularly been hearing it from youth who are watching how a number of different factors are changing the labor market as we speak. But I think the message I want Canadians to receive today is that the federal government's working really closely with provinces and territories to both protect workers in any downturns, but also to ensure that skills training remains relevant and is actually better coordinated with the needs of the market as it transforms.
Of course, in the immediate, we have jobs that are at risk because of a trade war. Just fresh news about Stellantis moving a line to Illinois that we thought was going to stay here. Support for workers, I guess we'd hoped would be a short-term stopgap. Some of it might be longer term now. Is the government kind of prepared for that?
We are actually, and just after the election, we took a number of steps to improve both work supports, but also EI supports for workers that would be impacted. We knew both things would likely be true, that some workers would lose their jobs and that some workers would need to have support to reskill quickly as their particular industry or company was pivoting to either new products or markets. So we have transformed EI in large part to provide better access to immediate financial supports, but also longer duration EI, as well as supports for training and skills through additional boosts to the labor market transfers that provinces get. And by the way, they're able to really closely track who's been deeply affected and then proactively reach out to folks for immediate opportunities for skills retraining.
And there's been already a lot of money earmarked for that skills retraining, very topical today, including for jobs that we don't really even know about yet. How quickly can we respond? The money can be allocated, but how quickly does it actually turn into meaningful output you can measure?
Yeah, it really depends on the sector and the circumstances of the particular company or region. But I can tell you that there are many companies right now taking advantage of something called work sharing, which allows them to reduce the number of hours that they're paying for an employee, but keep them attached to that job site while they do that retooling and reskilling. And this provides the financial support for the employee as well to not lose a tremendous amount of pay while also staying attached to that workforce. And what employers have said about programs like this work sharing program is it's actually a big boon, because they know that if employees leave their workforce permanently, that it's often hard to track them back. I've certainly seen that in Northern Ontario with a number of different companies that go through sort of a boom and bust cycle.
You know, you mentioned young people. Part of the problem we've had, of course, is there was a real tilt and a bias towards, well, away from skilled trades, towards, you know, getting a college or university degree and going off down that track. We need young people to do the opposite now. Can we make that pivot, which is almost a messaging one as much as one of kind of practical application?
That's very insightful, Amanda, and I'm really glad you said that, because we have actually been investing in skills trades training in partnership with unions, in partnership with colleges, in partnership with provinces and territories. We've provided incentives for diversification of the trades. We need more people to think of the skilled trades as a great paying job or career path, but the challenge really is one of psychology as well. And, you know, I remember being a young person where entering into the trades was really discouraged. People were really pushed towards a university system, a system of academia or higher learning, and the trades were seen as sort of the poorer cousin. But in fact, the opposite is true from an earnings perspective, and that's the message we have to get across. These are highly skilled, in many cases deeply technical jobs that have great paychecks and a great future.
So good to have you, Minister. Appreciate your time.
Thank you very much.
Patty Hajdu is Minister of Jobs and Families. Time for the takeaway, and when an argument has circular logic. This week, OpenAI made yet another big announcement with a technology partner. This time it was Broadcom, with a plan for the AI company to develop its own chips. But it's just the latest announcement from OpenAI with a big name in chips and servers. Intel, AMD, NVIDIA, and Oracle have all lined up to make a deal with the company at the heart of the AI explosion. The problem is that almost all of those deals involve circular finance. For instance, NVIDIA is giving OpenAI a bunch of money via an investment, and OpenAI is using that money to buy NVIDIA's products. This would be troublesome if it was only cash, but since the money in question is really high-flying, publicly traded stock, it becomes of interest to the whole market. So far, OpenAI has almost $1 trillion of commitments on paper to buy technology, while its revenue is closer to $12 billion, though that's just a report since the company doesn't disclose its financials. Of course, there's no question it's growing fast. One estimate suggests OpenAI now has 700 million weekly users of its ChatGPT AI product, but how that translates into sales, let alone profit, is less clear. What is clear is that the biggest players in tech want a piece of its business in future, and they're willing to invest a great deal of capital now to secure it. To grow at the rate it hopes, OpenAI will need massive amounts of computing power, including data farms and chips, and so it makes sense to lock them up now, or at least it makes sense until it doesn't. If another company does an end run around OpenAI, and several big players are trying to do just that, including Google, Meta, and Canada's Cohere, all of this investment could be for little or nothing. And that in turn could burn investors in the companies who are betting on one outcome. My takeaway? Maybe financing future growth is perfectly logical, but we've seen circular finance in the past, and it didn't end well for the stock market. That's Taking Stock for this week. I'm Amanda Lang. Thanks for being with us.